Hi guys, good night. Uh, my name is Gustavo. I'm gonna be the host of the event. In fact, I'm the vice president of the CFA Society Brazil, and it is a huge pleasure to host this event with two key knowledgeable speakers, John Bowman and Flavio Cagno. Okay. That said, let me just provide you some information before we start. Okay. Uh, I welcome everyone here to this promising discussion. Okay, uh, in my view, alternative investments is somewhat broad and very interesting, right? And within this context, I think John and Flavio will be key to provide some insights to everyone, and I appreciate them to accept our invitation. Okay, in terms of housekeeping messages, okay, please, guys, follow us in social medias, right? Okay. Throughout the social medias, we disclose a weekly agenda of the events that are organized by the CFA Society Brazil, the events organized by the CFA Institute, also some key events from other societies, in addition to some interesting investment related content. Okay. Uh, and I must highlight that many of the events that we list in our social medias in the agenda that we post, they are open to the general public. Okay, the CFA Society Brazil is present on LinkedIn, Twitter, Instagram, Facebook, and YouTube. And especially on YouTube, we save the webinars. In fact, these webinars will be saved on YouTube, so you can watch later. You can forward to your friends, and you can follow us in YouTube as well. Okay. Since the COVID-19 outbreak, we have shifted the events from in-person to online events. And since then, we have organized a number of events, which all of them are available at YouTube. Some of the events that we organized are the ESG. We also discussed about investor trust, the current investment environment. We also had two webinars on position papers, one about accounting for analysts, and the other about access regulatory information in prospectus, in red herrings. Okay. Tomorrow, the CFA Institute will be hosting a career development webinar, where it will discuss how to brand yourself to attract career opportunities. And this is the type of events that we also disclose in our agenda. And apart from this career event from CFA Institute, the CFA Society Brazil is running a webinar about the role of crypto assets in portfolio management. Okay. That said, we are being pretty active throughout the past 2-3 months. Okay. I discussed about following us in social medias, all the events that we are running. Now I'd like to talk about the CFA Research Challenge. The CFA Research Challenge is a student competition that we run every year. It's free for students. Students have to create a group between 3 and 5 students, and these groups of students they write reports about a specific company. Okay, and in Brazil, all groups are write about the same company, so they are evaluated within the same terms. Okay, and recently in Brazil we saw a brutal change in the number of groups. Our competition in Brazil is the second largest in the world. We only lose for India, which is not bad given they have 1 billion people. So like we have a pretty big competition, and that's a consequence of how the market is seeing the value of the students that go through this competition. Since they learn a lot, since we train them, since we provide the students assets, they become very valuable for employers. So that's a consequence. By being valuable by employers, lots of students register to participate of the competition. Okay, especially last year, we sent 2 teams to the Americans round, And our two teams won the, our two teams participated of the Americas final, which were INSPER and Poly, USP. And Poly won the Americas final and went to the global final. Okay, so we are very well represented by our students. Okay, so the message here is please disclose make sure that the message is conveyed to other people. The competition is free. Every student can participate. They can be undergrad, which is graduação in Portuguese. They can be doing postgrad. They can be doing masters. They can blend. As long as they are enrolled in a college and they are from the same college, they can all participate. Finally, I would like to ask you to help me announcing or making sure all universities, all students know about this competition and all students can participate of that. And if you want to know more details, you can access our website, cfasocietybrasil.org.br, and also follow us in our social medias because we're going to announce, we're going to provide more information about that in our social medias. Okay. Another housekeeping message, it's important for the CFA charter holders to renew their memberships until the end of August. And something that we're disclosing is that if you are not working in the finance industry, you have the option to apply for professional leave, which is very interesting because you're going to pay a substantially lower annual dues if you apply for professional leave. Okay, so that's the tip that I offer you. And finally, shifting to our webinar, generally speaking, alternative investments include a number of subclasses, if you will. For instance, it includes private equity, real estate, natural resources such as farmland, timberland, real estate, commodity investing, hedge funds, managed futures, structured futures, and private debt. In 2004, alternative investments comprised of 6% of the overall assets in the market, or just $4.8 trillion. Okay. But demand for these alternative investments have boomed in recent years through endowments, pension funds, and institutional investors that were willing to accept other types of risk premium exposures. They were willing to accept illiquidity. Okay, so by the end of 2018, the alternative investments almost tripled, going from $4.8 trillion to $13.4 trillion. Not only that, but according to Perquin, global alternative asset managers now they currently have $2.4 trillion available to spend. So there's a lot of firepower behind that. Okay, there's a lot of room to increase exposure in alternative investments. And behind that, you have some investors that are looking to improve returns at the same time that they reduce risk, because something that the speakers can discuss is why do you think investors look for alternatives? Is it for boosting returns, or is it for its low correlation with traditional assets? Okay. And the moment couldn't be better. If you see GDP growths are stalling, interest rates are reaching record low levels. In fact, we're seeing a negative rates, right? And that's happening globally and also in Brazil. Our 10-year bonds are now yielding inflation plus 3% in Brazil, which is ridiculously low if you look on a historical basis, because not too long ago we had government bonds paying inflation plus 6%, inflation plus 7%. So in my view, and you guys can help me on that, this can be spurring, if you think, alternatives awareness and also attracting capital to this kind of asset. And you see that investors are tilting their portfolios to gain more exposure in alternative investments. In the beginning of June, CalPERS committed with $4.3 billion to alternatives. BlackRock has $2.23 billion in cash to invest in companies that are struck by the pandemic. In Brazil, we saw also a big increase in the number of individuals investing in REITs, which in Brazil are called FIIs, right? As a response of falling interest rates, we saw XP also launching its private equity fund available to qualified investors. Fintechs are tapping the private debt market. And pension funds, if you think. Not too long ago, pension funds had a benchmark, which was inflation plus 6%. And the only thing that they needed was to purchase government bonds, and they beat the benchmark. But that's not the reality. So with that in mind, I'll open the floor for John. He will provide some initial remarks, then Flavio, and then we open to questions. Those that are willing to make any questions, you can send me a private question and I'll read, or you can write the question in the public chat and I'll pack them together and relay to the speakers. John and Flavio, thank you. Please be my guest.
Well, thanks so much, Gustavo. Can you hear me okay? Great. Well, greetings, everybody. I see a couple familiar faces and I see a whole lot of familiar names. Let me just start with the obvious distracting background because it has significant resonance, I hope, with some of you on this call. I recognize some names, but just above my head there is myself at what was the February 4th, 2017 opening of the CFA Brazil office. So I've been with CAIA about a year as Senior Managing Director, but as some of you know well, was with CFA Institute for about 14 years, and the last few years of that tenure were heading up the Americas. And some of my most proud accomplishments were that day on February 4th, with some of you right there in that picture, opening the Rio Test Center back up, crossing over 1,000 members. There were some great times, some great moments, some great memories, and I miss seeing you. The last time I was down there, it was for your annual conference at the Hotel Unique, and I cannot wait till this pandemic is over and I can come visit again. So I'm going to switch off of this very distracting background now for all of our benefit and get started. So I think many of you are familiar with CAIA, but let me just kind of ground us there because I think it's important context to my comments. We are the professional body, the global professional body for the alternatives industry. So just like CFA, we're not bound to serve any particular master. We're not a trade group that's subject to representing a certain constituency or protecting a revenue stream. We're liberated just to provide an objective voice that represents underlying investors, underlying beneficiaries, to ensure that the original purpose of finance, just as CFA would say, allocating capital to the most socially beneficial cause, is protected. That's what CAIA is all about on the alternative side. And so we're neither blindly supporting alternatives nor blindly demonizing alternatives. We're there to wear the white hat of saying the right thing, the objective thing, in order that the greater good is presses on. And we're all about, this will sound familiar, education, thought leadership, running events, and advocacy. Of course, most of you know us as running the industry-leading credential called the CAIA program. We have 12,000 global members in about 100 countries. You should know it's the only commercial I'll have all night, I promise, that if you're a CFA charter holder, you are waived through level 1 of the CAIA program, so you can go directly to level 2, so that's something to think about perhaps. Latin America, and particularly Brazil, is newer to us. And that's something I want to stress tonight, is that is an increasingly important part of the world. And given my experience and huge appreciation and fulfillment and the time I spent with CFA down in your part of the world, I'm really anxious to make sure that we build some momentum and accelerate that take up and reputation down there as well for CAIA. I pulled some of the member numbers. We have about 74 members there in Brazil. If you broaden that to all of Latin America, it's about 192. So not very many. And if you look at, we worked with Preqin to try to get a sense for market sizing of what is the denominator that 192 is the numerator for, meaning how far have we penetrated into these markets. And in Brazil, we came up with a number, and I won't go into how we calculated it, but of effectively 2,300. So 74 over 2,300 is only about 3%. So we're at the very front end of this experience. And in Latin America, more broadly, it's only about 4%. So the story is young, exciting, vibrant, just as your part of the world is generally for CAIA in Latin America. US, just as a comparison, is about 6% penetrated, Canada at 12, and the world at 6. So other than small exceptions like Canada and Switzerland, where we've planted a flag for a long time, we are still in the very early stages of our Latin American experience, and we're really excited about Brazil. So much so that part of what I wanted to announce today preliminarily is that we've been working closely with Anbima on their CGA program. And you might know now as CFA charter holders that if you want to be certified through Anbima, that you have to take 2 exams, but as a charter holder, CFA charter holder, you only have to take the second one, the one that's more specific to jurisdictional products, regulation, and so forth in the Brazilian market. And CAIA will soon also be, CAIA charter holders will also be waived from that first exam, the CGA Essentials. And so what a CAIA charter holder or CFA charter holder will be able to do is just skip right into that second exam, depending on whether you're going the mutual fund route or the structured product route. You'll just take the single exam. So we're really excited about that, and we hope that that's a little bit of an accelerator, as I said, to our penetration and our breakthrough in Brazil. I want to just make a few comments as we launch into the panel, and I'm really excited to be here with Flavio to talk about alternatives. And I want to kind of categorize my brief comments with the very provocative title of Alternatives Has a PR Problem. And what I mean by that is first that private capital is here to stay. In the last 2 decades, we've seen one of the major secular shifts in the last century, and that is that companies are staying private longer, and they're raising capital much more effectively in the private markets. This has been a tectonic shift in the way that companies seek, attract, and build their growth capital. If you just look at the US, take the Wilshire 5000, 1996, it got to a peak of about 7,500 listed companies, and since then it's halved. So the Wilshire 5000 is a misnomer. There's only about 3,700 listed companies in the States now. And this is particularly acute in the new economy or small cap or service-oriented or knowledge industries. These type of innovative companies are staying public more so than the larger cap companies. And so what's left, and I'm stereotyping a little bit, is more tired industrial, heavily tangible asset type of organizations that still are relying on the public markets. You also have seen that IPOs have collapsed, and this is the case if it weren't for China around the world. The world is slightly flatter than the US. The US has kind of cratered the developed world. If it weren't for China, that would be a world story. But you might recall that in the heydays of the IPOs, the 90s and even early 2000s, right, the reasons that you went public as an original owner were manyfold, right? You wanted to monetize your original ownership as the founders. You wanted a acquisition currency to start, those public shares. You could acquire other companies, merge with other companies. You obviously wanted access to growth capital through the public markets. And then there was also this kind of reputational halo effect, is that I'm public. There was something really exciting, kind of a rite of passage in doing that. And I would argue is that nearly all of those, if not all of them, are fully satisfied now in the private side of the marketplace. And in fact, you could argue that the reputation, the kind of excitement of being private is even more attractive than being public these days. That whole proposition is kind of turned on its head. And that's because the public markets are filled with a lot of costly regulation. You have to deal with activists, you have to deal with this rampant short-termism, and you get away from focusing on long-term value creation. And instead are focused, getting distracted into the gyrations of the day-to-day movement in the public markets. So private capital investors have found that the benefits of staying private longer are this idea of information asymmetry. There's less information, and it's not as ubiquitous. It's not as shared. So there's dislocations, there's opportunity for inefficiencies, there's less competition. You can invest across a life cycle of an organization. If a company's not going public till they're very mature, you've missed most of their growth stage. So getting in early allows you to participate in that upside. And let's be honest, one of the things, half tongue-in-cheek, that I might say too is the illiquidity could actually be a good thing in saving us from ourselves, right? The day-to-day opportunity to trade, to be mark to market, sometimes can be dangerous to our human condition, in that it drives fear, it drives fickleness, it drives reaction. And so I say that only half jokingly, but illiquidity can actually be an asset sometimes. Just taking an example, in 2004, Google, when they went public, when they did their IPO, it was about $2 billion back then, their IPO. They had raised about 25 million in the private markets at that point, very small. So it was a 76-to-1 public to private ratio as far as their capital raising. You fast forward to last year, 2019, probably the most highly promoted IPO was Uber. Uber had a very large IPO, 8 billion, and yet they had already raised 22 billion in the private market space. So that ratio went down to 0.37. And again, some are choosing not even to go private. So this whole private capital explosion and shift is not going away. This tide has come in. The growth has really been meteoric, as Gustavo has said. When CAIA first started in 2002, alternatives represented about 6% of total investable assets, about 5 trillion US, roughly. Today, as Gustavo said, it's a little over 13 trillion, representing 12%. So it's doubled as far as its percentage of investable assets. The way that breaks up is, roughly speaking, about 4 trillion each for private equity and hedge funds, about 3 trillion in real estate, about 1 trillion in private debt, and then about 1 trillion between the other real assets like infrastructure and natural resources and commodities and so forth. A little over 13 trillion. And a recent study of our members suggests that this is going to continue to rise. They told us that they expect by 2025 this number to reach 18 to 24%. So it could double again as far as its percentage of investable assets. And we expect, depending on regulatory, and maybe we'll talk about this, Gustavo, depending on the regulatory wins of the high net worth or the retail investors' access to alternatives, that could even be an understatement. The institutional investor typically is around 30% invested in alternatives. Retail investors are only, high net worth investors that is, are only about 5% invested. So it's very early on the retail side. So huge growth. This is here to stay. But unfortunately, as I said, they've got a PR problem. They're often seen as alpha boosters only, as the next bastion of outperformance, as a sure way to close the retirement gap. You mentioned CalPERS, Gustavo, is that it becomes kind of a casino trip where the underfunded pension or meeting your retirement goals, if you throw in this high octane stuff, you can get a little bit more alpha out of it. And I think that we've lost the ultimate purpose of alternatives. And the media is responsible for this, the academics are responsible for this, but the industry too. GPs and LPs we have to take some responsibility for this, because a long-term pool of capital benefits from diversification away from public securities to a degree for purposes of lowering volatility, for purposes of reducing drawdown risk, for inflation protection, for predictable income streams, for uncorrelated cash flows and revenue drivers. So sophisticated fiduciaries, they want to construct a portfolio that represents a collection of betas that over the long term helps you achieve your investor outcomes. Yes, there's a little bit of alpha thrown in here or there, depending on where your skill set and edge is, but ultimately it's about collecting a group of betas that have very different behaviors, putting them together to ultimately achieve your goals. And that's the important role that alternatives can play. And so it's because of this continued trajectory in the growth, coupled with this PR problem that, and I'll end with this, the CAIA Association has recently launched a 4-point call to action. This is a rallying cry, a challenge to everyone within the industries, LP, GPs, consultants, regulators, academics, to stand up and stand firm. And we actually called this report, this call to action, from adolescence, from teenagehood effectively, and I've got lots of teenagers, so I know how they act, to responsible citizenship, meaning we need to grow up, we need to mature into a profession that earns public trust, that earns investor trust, a public warranty as other professions have. And those four things, just very quickly, are deepening education. We want education of a high profile professional designation to be an entry point, to be the doorway in. There needs to be barriers to entry to a profession. And we think CAIA, certainly coupled with CFA, can be a great tool for that. We want to improve transparency and standards. And this is probably, of all of them, probably the most important message. And when it comes to performance comparison and fee structure and defensibility of fee size and standard of care, calculating the carry, these are all underformed issues, non-standard, non-uniform accepted principles that need to be worked on for this to be accepted and investors to be protected. We want to proclaim, thirdly, the merits of diversification. We've had a really funny decade. Prior to February 20th, you could look back, and I don't mean to suggest that any of you are not hardworking, but you hit that easy button and go home for a decade. I mean, let's be honest, it was 60-40, maybe even 100 public equities. Like, what was the point of diversification? It was the first decade since 1850 that we didn't have a recession. It was the first decade on record where we didn't have a bear market. So let's be honest, it was fairly easy, but for anybody that studied markets over many decades or experienced corrections over multiple cycles, we know that that was everything but normal. And that's where diversification comes in, as I've said. And then finally, fourth is democratization. So education, transparency, diversification, and then finally democratization. We believe strongly in opening up access to alternatives for other types of investors, but it has to come with safeguards and protections to ensure that the unsophisticated investor on balance is protected, is properly educated, and is watched over by a fiduciary. So I'll end with that. I'm sure there's lots of questions and sparks based upon some of those comments, but I'll hand it over to Flavio from here.
All right. Hi, Gustavo. Hi, John. And hi, everyone following the webinar remotely. It's a pleasure for me to be here with you guys. Thank you so much for the invitation. I would like to take the opportunity to thank Gustavo and Lucas from the CFA Society Brazil for having the initiative and patience to organize this event. Brazil needs more institutions such as the CFA Society committed to high-level professional education. We need that to make Brazil a better country for us all. Also, I'm very happy to be a guest with John. John, it's a pleasure to be with you virtually again. I hope we can meet in person soon for a round of caipirinhas that Gustavo promised to buy us. And I was very impressed by your introduction. I'll try to deliver my talk bringing real information on the alternative investment segments we have at Kinea, which are real estate, infrastructure, private equity, and venture capital. I'm a partner at Kinea, which is an investment management company. I think it's worth mentioning that Kinea's creation was based on the idea that Brazil would eventually have low interest rates and people would need to add other types of investments besides fixed income to their portfolio. In 2007, Itaú bought Bank Boston, and a group of Bank Boston's senior executives led by Márcio Verri, who is Kinea's CEO, decided to start an investment management company dedicated to alternative investments. Back then, rates were extremely high, but the guys had this vision that this would eventually change. Guess what? It took only 13 years. To be honest, Kinea has only thrived in the last 5 years, exactly when Brazil started making the structural reforms which have led to lower rates and more fiscal stability. Although it's been a really bumpy road, I really think the country is going the right direction because of fiscal stability, and low rates are a major catalyst for an alternative investment industry boom. Besides that, online investment platforms have become really popular because they offer easier access and a broader range of products to retail investors. So that's the democratization aspect that you are mentioning, John. Brazil has always been the homeland of high interest rates. Until recently, investors were able to leave their money sitting on their bank accounts and still earn more than 10% a year. It seems to us that this reality is finally over, or at least it's over for the foreseeable future. This fact alone will have a dramatic impact in our industry, in my opinion. Believe it or not, Brazil has only 2.5 million individuals investing directly in the stock market. That's little over 1% of the total population. And if you think about it, we may argue that even public equities are alternative investments in Brazil. As I mentioned, the country has been leaning towards a path of fiscal responsibility since the end of former President Dilma Rousseff's administration. And more recent administrations have carried out key structural reforms which have led to shrinking interest rates. And despite all setbacks, we believe the country is in the right direction towards fiscal responsibility and more stability overall. The low interest rate environment will force people to invest in alternative investments, but the main question is whether or not these low rates are sustainable. I think that's my introduction here.
Okay, so I'll get some point that first what John mentioned about regulation, and if you could both discuss, John taking the global view and Flavio a more local view. Regulation is important in many industries. What do you think could be or will be the main headwinds and tailwinds of alternative investments globally and in Brazil?
You want me to start, Flavio, on the regulation? Nearly every jurisdiction around the world defines accredited or eligible investors for private placements or these opaque non-public investments through a binary rule that is built upon either your wealth or your income. And the US is no different from Brazil in that Brazil has a two-tiered system, but it's very similar in philosophy. The SEC here in the US has opened a dialogue that I expect to start a domino effect around the world that has challenged that binary view to say, should this really be about income? Because there's a proxy for investing in, quote, more risky assets, in that if you have more discretionary income, you're able to absorb more capital loss. I understand that. On the other hand, shouldn't this be about education and awareness versus income, or at least and education, not just income? And so the SEC is mulling the idea of expanding that accredited investor rule to consider minimum education requirements that would potentially waive some of the income requirements, or at least be an additional condition. And I think folks like CBM and other equivalents around the world are watching very closely to see what happens. As I mentioned before, the typical high net worth investor has about 5% alternative investments in their portfolio. That could not only increase at the accredited investor level, but if mass affluent and retail are allowed to have access here, then that could be a windfall for the industry. Obviously, we have to be very careful here, and I'll just put the one cautionary flag on this, despite us being generally positive about this change, is that the dispersion of many of these managers and the GPs that represent them is extremely wide. And so when we look at the illiquidity of premium or the alpha, the outperformance of PE or private debt or hedge funds against some of the tradable public strategies, often what you see is the top performing managers that create that alpha. And there's a Cambridge study that looks at kind of the difference between the top 5th percentile manager and just the median. So I'm not even talking about 3rd and 4th quartile managers here, 3rd and 4th quartile managers here, just the average, okay? So if you were to look at just public equities globally, that is a very tight window. It's less than 4%, meaning if you pick the best manager versus the worst manager, 400 basis points is the difference. As you move into more less efficient assets like small cap equities, that goes up a little bit. Investment grade debt is very tight, lower than 2%. As you move into alternatives, it starts to balloon. So for example, global real estate, 15.2% difference between top 5th percent, the best managers, and the median. You move into global private equity, 21%, and global venture capital, 33%. So when I talk about safeguards being for democratization, for the diversification benefits I mentioned earlier, but putting protections and safeguards, these regulators need to balance that with, is that if you're going to open the floodgates for an unsophisticated investor to attempt to choose a GP, it's very unlikely that it's going to end well because of this massive dispersion. And so we need, the regulators have a lot of complex work to do. It's not just a decision of yes or no. It's ensuring that we do this well to protect the nest eggs of these retirees. Flavio, I don't know if you have more to add on the Brazil.
Actually, interesting comment, John. I don't know if you knew that, but most of Brazilian regulation was inspired by USA regulation. For instance, REITs. We are just a copycat of REITs in America. So I think Brazil has solid institutions, and although there's room for improvement, our legal framework is good. On the other hand, I think we have to invest in financial education so that professionals are better prepared to offer alternative investments to clients, and so that clients become aware of the risks they are actually running. We've been seeing this democratization of complex products over the past 2 years, especially because of the success of some independent retail platforms. So we are seeing private equity funds being distributed to retail investors, venture capital funds also, which is good. But I really think we have to put some effort on education as well.
Yeah.
Flavio, you mentioned about education, and John mentioned about education in the opening remarks. Now starting with Flavio, throughout the past, let's say 15 years, how do you see institutional investors and the general public, how was the path in terms of educating them or having them educated towards alternative investments in the past 15 years? And how do you see it happening in the next 2 or 3 years, which in Brazil, it's a very long term, right?
Yeah, it is. 2 years in Brazil, it's like a decade. I think I can provide some examples related to actual segments of alternative investments. For instance, private equity. We've observed a major increase in the participation of individual investors in the PE funds managed by Kinea, whereas only 20% of our first fund had individual investors. This figure is now around 80% for the more recent funds. PE funds used to be only available to high net worth individuals, but recently the retail investors have been able to access PE in newer funds. We believe this democratization will accelerate over the upcoming years, especially if rates remain low. And it's interesting to see that public pension funds have been out of the market in the past few years due to the negative repercussions of Operation Car Wash. But we believe they will have to rejoin eventually because of the low rates. And this is also true to infrastructure as well. Prior to 2014, the sector had been strongly associated with corruption. In fact, Operation Car Wash had a dramatic impact on the sector because of all the scandals and lawsuits. Several players ended up leaving the scene. State development banks used to be key figures in the infrastructure alongside large private contractors. This has finally changed, and state development banks have no longer have lead roles in the sector. So there has been a lot of changes in terms of the profile of the investors depending on the asset class.
John, if you'd like to complement. Okay.
Yeah, I guess I would just add briefly that when we think about education, yes, it's the underlying investors directly, but we also need to think about the gatekeepers that work with those underlying investors. And there's a two-tier system, sadly, in most developed financial markets, in that you have investment advisors that are usually held to a high standard of care, best interest, fiduciary role that usually require heavier levels of training and ethical code of conduct. And then the large majority of people actually work with what we might call broker dealers or financial agents, right? Who are not held to that same standard of care. So when I talk about education, yes, I'm talking about investment acumen, the stuff that the majority of us studied on the CFA and the CAIA exam, but I'm also talking about standard of care and ethical responsibility and code of conduct, because most of the education is going to be through the conduit of whoever that representative is looking after the individual. And if we're not training both the underlying investor and their advisor, then we're ultimately going to let down those individuals as well. So because that trust contract is strong, as it should be, but we need to make sure that that trust is undergirded by strong education.
Oh, go ahead.
No worries. If alternative investments are adolescents in the USA, in Europe, or Europe, Brazil, I think we are at most newborns. So we are giving the first steps on this direction. As I mentioned, we have been always the homeland for high interest rates, zero risk fixed income products. So we have a long journey ahead of us.
Thinking about not institutional, but individual investments, what do you think are the main channels for individual investors to start knowing about alternative investments? And do you think if they start, let's say, I'll provide a spoiler, let's say like real estate, do you think it's easy for them to unfold into other subclasses or segments, or the individual investor, they see it separately, not as a whole asset class?
Oh, well, I'll give my opinion, but for me, it's very clear that Brazilian investors are more familiar to some types of alternative investments, such as real estate. So Brazilian people have always liked investing in real estate. Real estate assets have served as a protection from hyperinflation, which had plagued Brazil for many decades in the last century. And now REITs have become a very popular type of investment in Brazil. I don't know if you knew, Gustavo, but currently almost 1 million individuals invest in REITs in Brazil. You have the tax incentives, liquidity, income distribution, professional management. But I think it has to do with our Portuguese heritage as one of the main reasons, because we feel comfortable with real estate. Portuguese have always believed that real estate is the most solid investment one can make. So I think it's easier explaining real estate, maybe infrastructure, as opposed to private equity to some investors. On the other hand, we saw newer private equity, venture capital funds, which are very complex, having a very successful distribution for retail investors last year. So I think people are drawn because of the technology side and innovation aspect of these vehicles. And it was something that had never happened before. Imagine a venture capital fund being offered to retail investors. So we are seeing a lot of progress and a lot of improvements, but I think we still lack depth in terms of knowledge, not even to investors, but also to the professionals that are selling the products to the investors.
Yeah, I guess we'll just add a couple quick points in that. I would echo Gustavo. Maybe you were leading the witness there with your question, but these are not asset classes. They're in many ways a collection of strategies. I explained the dispersion. When you've got 2,000 basis points between the top fifth and the median, there's no way to invest in a passive representation of that, right? It's all about manager selection, which makes it really opportunistic but dangerous for an unsophisticated investor. I believe Brazil is mostly still defined benefit plan. So obviously the defined contribution explosion up here in North America is starting to toy with small allocations in certain types of those 401k plans for investors. But I believe Previc and CVM already allows for up to 20% or so of alternative allocations. So it's there, but if we're talking about educating the individual with a liberalization of the accredited investor rule, then that's going to open up, as I said, lots of opportunity for direct participation in private placements that needs a whole lot of protection, as I've said a couple of times.
Okay, one question here, more geared towards John. Do you think, how do you see large pension funds, or let's say endowments, that are creating some dedicated alternative teams instead of investing through managers? Do you think it's a trend, or do you think that's going to be, let's say, a niche to the extent that that's only going to happen in large large investors?
I think the answer is yes to both those questions, which maybe is a hedge in itself, no pun intended. But if you see the major public pension plans, the sovereign wealth funds, the really large university endowments, as you said, they are starting to insource this expertise, this talent, these teams in-house. The old days is you effectively had maybe one, with the exception of maybe the largest public pension plans, you usually had one investment officer, and you had a consultant from one of the big folks, and they did all your manager selection for you, and you kind of plugged in, and the board kind of was involved in the details and micromanaging what that investment officer was doing. You've now got CalSTRS and CalPERS with 300 plus people, and as you've just alluded to, they're insourcing now real asset and private equity and hedge fund or diversifying strategy teams. I would say that for that scale, Gustavo, it makes complete sense, because what they're doing is saving literally millions of dollars of management fees. And that's not to say that in some cases those management fees aren't paying for strong expertise, but if you can buy that internally and scale it, it's going to be much more cost effective for you over the long term. What you're also seeing on top of that, which is you kind of alluded to in your question too, is that in addition to insourcing the manager selection process, they're also starting to insource perhaps even portions of the GP role, meaning there's co-investing where these GPs are allowing LPs to come in alongside of them rather than as a limited partner. And even some of the largest are doing direct investing themselves. They're actually running, take real estate, for example, they're doing property management or they're managing the property managers. So they're disintermediating the GP completely, or they're playing that role themselves. Obviously that has trade-offs. So I don't think you're gonna see 95% of asset owners on the endowment, the foundation, family office side. That would just be silly to attempt to replicate that internally. But given the pressure on fees, the transparency I mentioned about how are you calculating your management fee? Is it really worth 200 basis points? What's in there? And should I really be sharing, 20% of the upside? And when does that upside kick in? Is it after a hurdle rate? And when does that hurdle rate kick in? Is it at each deal, or is it at the full fund level? There's lots of questions that these fees have not been nearly as transparent and uniform as they should be. And the larger, more sophisticated asset owners are starting to take advantage of that. So I do think that trend is going to accelerate, but certainly it'll be the very top portion of the universe, not the majority.
Flavio, not sure if you want to compliment on that.
Oh, well, I don't think I have too much to add, because US is like way ahead of us. We are starting to be investors in alternative investments. So I think we have a lot of challenges here, our own challenges, but I think we are not there yet in terms of all the repercussions that US is facing now.
Okay, so one question for both. I'll start with Flavio. You mentioned that Brazil is I'm not sure, it's a toddler, right? It's a newborn. And Brazil has all kinds of trust not all kinds, but Brazil may have trust problems with fiduciary risks. Do you see investors, instead of, let's say, undertaking investments in alternative investments in Brazil, opening offshore accounts in order, let's say, to remove cash from Brazil and invest directly, let's say, in the US? Or that's not a reality in Brazil? And that's for Flavio. And John, do you see this kind of movements happening in countries that are, let's say, still infant? Local investors investing abroad because of the lack of debt locally?
Well, I mean, it has been very common for Brazilian wealthy people to invest abroad and to take their money away. Now we are seeing a huge offer of offshore investment products for the retail investors. So you are able to invest in a manager from like a PIMCO or whatever abroad. So there, and it's a very recent type of offer. But I think there are a lot of reasons for people to invest in Brazil, Gustavo, in alternative investments. For instance, we see that alternative investments are able to reduce risk because of the low correlation with traditional assets. We are watching infrastructure products. We have an infrastructure area at Kinea, which has grown a lot, and the projects have been showing solid results since the pandemic began. Also, a lot of products have significant tax benefits for individuals. This is true for real estate, agro credit, infrastructure, and this is, in our opinion, a major drawing point to most investors. So with this exchange rate of almost 6 reais per dollar, it's really hard to invest abroad, because if the rate appreciates, if the real appreciates, the return won't be so significant. So it's tricky, but there is a lot of offers of new offerings to invest abroad.
You know, I don't have nearly as much local expertise as Flavio, but I would say, you know, the historic reason that most institutional investors in Brazil pursued offshore investments is that it opened the investable universe. Either they were prohibited from investing in some of that, or there was a cap on it, or there was just no offering yet. Again, the toddler idea in Brazil. It certainly wasn't because, as you said earlier, that the risk-free rate was particularly attractive outside Brazil. I mean, as you said, you could plug into a government bond locally and hit your actuarial rate. I mean, California pension funds would die for those 8, 9, 10 risk-free rates if you could. Now that you've got record low interest rates in Brazil, it would be interesting from kind of a cost of capital perspective to see how that dynamic changes. Because it's not as you've kind of neutralized the rate issue at the moment. The central banks, as you know, are working very hard around the world to continue to pump more money and keep those rates lower collectively. So the reasons would certainly not be for rate perspective, given that most of the world is at record low interest rates. But it will be interesting to see whether some of these, especially if it opens up in the US before Brazil, if you start to see this offshore increase to get access to some of these newer asset classes.
Perfect. So as we approach our end, one question to both of you, John and Flavio, especially John mentioned that alternative investments will have a very broad array of returns. It's, the dispersion is very high. How do you find it? Let's say if I had money, how would you recommend me, which traits should I look for when investing in alternative investments? Which traits I should look for in the GP if I want to invest in alternative investments?
I can start with that, Flavio, very briefly, because I know we're at time. I would say a couple things. One is transparency and trust, always starting with that. Are these the types of individuals? Because remember, your time horizon is much longer. The J curve is really stretched out. It's taking kind of those public equity expectations and stretching it like silly putty. And if you don't want to go into battle with these individuals at the GP, if you don't really believe in their decision trees and their morals and their kind of ethical compass, it's going to be very frustrating. So that's one. That's always the table stakes. And then I would say that, again, given dispersion, you've got to be abundantly clear as to what you're looking for from your kind of risk budgeting standpoint. Are you looking for private equity, just as an example, for purposes of return enhancement? Then you're going to look at a different set of GPs than you are with, more on the venture capital side, early stage, than you are with, some of these growth or LBO type late stage diversifying capabilities. Or if you're looking for inflation protection, right, against your global macroeconomic expectation, maybe you've got real estate that you're pumping in. If you're looking for consistent, if you expect a lot of volatility on the public markets, maybe some of these infrastructure, real asset, natural resources, where you've got predictable low rates, low return, but predictable streams, will really help your drawdown risks. So it's far from one size fits all across these asset classes, and it's even more diverse within the asset classes, because again, they're not asset classes. And so it's critically important to know what you're looking for and then to invest with the right GPs.
Yeah, I agree. I think managers' track record is key. So you have to know who you are investing with. And if it's a real asset fund, such as real estate and infrastructure, you got to understand the quality of this asset. So I know that we are attracted by yield, but it's important to take a look at the actual underlying asset.
Okay, if you'd like to provide some final remarks, final comments, please feel free. The floor is yours, and I deeply appreciate for your time and for everyone's time in the audience.
Flavio, you want to start?
I just want to thank you, you guys, all people watching remotely, and we are happy to be with you and happy to help in any sense possible in terms of developing education in Brazil. So whenever you are here, John, we would be happy to do some type of event, a joint event of CAIA, Kinea, and CFA Society. Please feel free to reach us out. And thank you, Gustavo, once again for the invitation. It was a pleasure to be with you guys.
Yeah, I would just echo those comments. It's been an absolute pleasure, as I said, to see faces and names. And despite this COVID situation being unprecedented and really difficult, I found these technological solutions, not a perfect replication, but at least a way for us to keep up. And as I said at the beginning, I can't wait to get down there. I'd love to accept that invitation, Flavio and Gustavo. And I think there's huge collaboration, as I said, huge upside in alternative education in Brazil, but huge collaboration opportunity between the CFA Society and us. So I look forward to that day, and I'll buy the Caprinis. Still my favorite drink. Yeah.
All right, guys. So thank you very much. Thanks for everyone that
you guys
participated in the audience, and see you.
Bye-bye.